Okay, so let's start. So today we are talking about profitability index, and to set the context, what have we been talking about over the last couple of classes? Different ways of evaluating projects. So there is no rocket science here. What are the different methods that we've talked about? We've talked about NPV, IRR, the payback, MIRR. So all these are methods. Is there any limitation on what to use, what not to use? So you can use whichever methods you want, and the more methods you use, the more perspectives you get. Okay, so the last method that we will talk about today is a profitability index. I'll just explain the method and then set the context of why this is useful. The profitability index is the present value of future cash flows divided by the initial cost. So on a project, if you invest 100 and then let's say 1 year later, so this is year 0, this is year 1, you get 120, the discount rate is 10%. What is the profitability index here? Approximately, without using a calculator. One is not... so give me an answer correct to about 1 So the profitability index is 10%? What's the present value of the future cash flow? Yeah, about 109, 110. What's the initial cost? So what's the profitability index? So it is so that's approximately the profitability index. All we are doing is that's the name of this measure. I'll get into the interpretation shortly. So this is your profitability index. Now can you see the fact why do we say this, that the accept a project if the profitability index is greater than 1? Once in the orange t-shirt, your name? Zulfikar. Why do we say accept if PI is greater than 1? Yeah, so to accept a project, the present value of all your future cash flows, it has to be greater than 1. Is this equivalent? Is this the same as saying that NPV is positive or not? Yeah, so essentially this is the same as saying NPV is greater than 0. So if this is telling us the same thing as NPV, then what's the advantage of this? Osama?
Per dollar gain that you get.
Exactly. So it is showing a per dollar gain. What does that mean? Let's say you have two projects A and B, and let's say that the NPV of A is 10 and the NPV of B is 4. If these are mutually exclusive, then Saad, which project would you select? Just based on NPV. You would select A. Is A more profitable than B? Okay, let me just give you some more information. So we don't know. Why? Because let's say on A you invest $10,000 and the present value of the future cash flows is 10,010. Are you following what I'm saying? So if you invest 10,000 and then all the future cash flows, you take their present value and you get 10,010. All right. What's the NPV? 10. Does this look like a very profitable project? No. It's positive NPV, but not necessarily not that profitable. Versus on project B, you invest 10. So that's your investment. And what you get back, your present value of future cash flows is 14. Okay, is this a profitable project? This looks a whole lot more profitable. What's the profitability index for this? The profitability index will be 1.4. What's the profitability index for project A? Okay, so for A the profitability index would be 10,010 over 10,000. So the profitability index is what? So 1.001. So do you notice that comparing the profitability index of A with the profitability index of B, the NPV number doesn't tell you what's more profitable. It just tells you which has a higher NPV. But the profitability index gives you a sense for the profitability. And if the profitability index is 1, what's the meaning? What does that mean? Your name? Kamar. Yeah. What does pi equal to 1 mean? The question, very straightforward question. I don't want anybody to shout this out. The question is, if I tell you that the profitability index of a project is 1, how would you interpret that?
It's equal to the cost.
Okay, what's the NPV of this project?
0.
Very good. So if the profitability index is 1, that simply means the present value of future cash flows is equal to the cost. Okay, exactly. So if profitability index is 1.4, anytime you see a fraction, okay, so you have so profitability index is a fraction. So any fraction tells us how much of the numerator per unit of the denominator. So what 1.4 means that for every dollar invested, the present value of future cash flows is 1.4. Okay, so that's why it's called a profitability. So what's the advantage of, so in a very rough sense, what is happening here is the profitability index combines some of the positives of IRR and NPV. Remember, what's good about NPV? The good thing is that theoretically this is the most sound method. It makes proper assumptions. It doesn't have multiple, as in you will always get an IRR, always get an NPV. IRR, what were the issues? So multiple IRR problem, the discount, the rate at which we reinvest is IRR, which is an incorrect assumption. But what's good about IRR? It gives a sense for the sort of returns that you are getting. So that's the profitability index combines these two. Okay, now just to check, any questions on profitability index? Very good question. So what's the technical term for that? Yeah, so you have non-normal or non-standard cash flow. So let's create a simple example. You invest 100 and then let's say you get 50, 80 and then minus 10. Just sort of, if you are to diligently follow this formula, how would you come up with the profitability index?
Are these the present value?
No, the discount rate, good question. The discount rate is 10%. Or let me actually make life easier. Let's say that these are the present values to simplify the calculation. So what's your name next to Basit? Shahrukh. So what's the profitability index given that these are all the present values? So what you do is, so you simply, what does the numerator say? Present value of future cash flows. So Afan, what's the present value of future cash flows? The present value of future cash flows is 120. So what's the profitability index? 120 over 100, which is 1.2. So all you are doing is taking the present value of future cash flows.
Why did you ignore the interest rate?
I did not ignore it. I just told you that after taking the interest rate into account, these are the present values. I did it to make the problem simpler for you right now. Yeah, so I am just saying that these are the present values. Just making life easier, because I am assuming you know how to do what you just did. Okay, otherwise we'd have a larger issue. So I'm assuming that if I had given you 55 instead, the actual cash flow here was 55. So I did you a huge favor and just discounted the 55 and gave you 50. So I'm telling you these are the present values. If you have a problem, then we can discuss that later. Okay. Now, what is the usefulness of the different methods? We've talked about the pros and cons of different methods as we started them. Now, just a couple of slides to wrap up this discussion. So, payback and discounted payback. Does the payback method give us a sense for the riskiness of a project? So, Falak, what do you think? Does the payback method, how? Okay, so, how? Okay, Nabiha?
I think it does.
How? Exactly. Okay, one second, look, okay, you see, just some general piece of advice, okay. When you are answering a question or, thinking about what an appropriate answer is, in general, the first thing you should do is just think logically, okay? Just, what is a common sense? So I'll give you two projects. In one project, you expect to get your money back in 1 year. In the second project, you expect to get your money back after 20 years. Which one do you think is more risky? 20 years. The longer it is taking you to get your money back, the more risky, because the longer your forecast horizon, the less likely that your forecast is good. Right? No, there is much more to life than interest rates. Okay, if you don't know that what are the different reasons that you don't get your money back? Engro invests this big plant. Okay, it makes assumptions about how much gas it will get and assumptions about how much people will buy. Okay, so do you think they are first thinking about what will happen to interest rate, or more fundamentally what will happen to their raw materials, their supply, their demand? So just because this is a finance class doesn't mean that everything begins and ends with interest rates. Okay, so the larger point is that the payback period is telling you how quickly you get your money back, and the sooner you get your money back, less risky the project. Okay, no rocket science. Okay, no interest rate risk and this, that, and the other. Those are just relatively small components of this larger issue. Okay, so that's one. So it tells you your risk. It tells you your liquidity, as you pointed out. Okay, first there, then question, then we'll move on. Yeah. Generally, I'll go for the higher NPV. Yeah, so generally, we'll talk about this in more detail. Obviously, we are just trying to be very quantitative right now. So, if you are a fresh IBA graduate and you are doing an analysis, typically what you will do is you will go to your boss and you will say, I did a payback analysis. Payback period is 2.8 years. I did an NPV analysis. The NPV of the project is 1.8 million. I did an IRR. The IRR of the project is 17.9%, and you will give all your justifications. 10 years later, when you are the boss, then some kid will come to you and give you this data. You will take that data, several other pieces of information, you will apply your wisdom, and you will figure out what to do. So it is fairly subjective. Let me just continue, and just one more question, and then I want to go through the rest of this chapter, and when we are done, then I'll take all questions, general questions related. Okay. Now NPV versus IRR. Okay, so this is a recap. NPV gives a direct measure of the dollar benefit to shareholders. Okay, so when I say NPV is 4 million, that means that overall wealth generated is 4 million. But it does not tell us what the safety margin is or the sort of return is. What do we mean by this safety margin? If Engro invests 100 million and the present value of the future cash flows is 104 million, then what is the NPV?
4 million.
Is 4 million. Versus in another project, they invest 10 million and there the NPV of the future cash flows is 14 million. Here again the NPV is 4 million. So project A and B both are giving the same NPV. So the NPV of 4 million does not tell us that in this project the safety margin is much more than in the other project. Okay. What do you mean? So safety margin means that what if your assumptions are not quite right and your NPV ends up being a little bit lower. Okay, so if you had estimated NPV of future cash flows as 104, but it turns out that in reality the present value turns out to be about 5% less than this. Will it be shocking if your present value is 5% different from what you had estimated? No, 5% difference is probably quite normal. So is the safety margin in this, let's call this project B, the safety margin high or low? Its safety margin is low because even a small 5% deviation will make this a negative NPV project. Whereas in project A, if there is even a 10% deviation, are you still in the positive NPV territory?
Perhaps.
No, but not perhaps, 10% of... so if you are investing 10 million and your present value of future cash flows is 14, If your estimate is off by 10%,
12.6.
then your 12.6 is the present value, which still gives you a positive NPV. So the safety margin is clearly more here. All my simple point is that the NPV in of itself does not tell you about how much safety margin we have. It also doesn't give you a sense for the profitability, whereas IRR does give you a sense of the return. So if your cost of capital is 10% and in project A your IRR is 40%, whereas in B your IRR is 10.2%, can you just look at these two projects and say that, okay, my profitability is much more with A and my safety margin is much more with A? All right. So all I'm saying is that the IRR metric gives us a sense for the safety margin. So if I have cost of capital is 10 and project A has an IRR of 40%, project B has an IRR of 10.2%, given the IRR rule, would you do both? Yeah, given the IRR, in both cases the IRR is more than the cost of capital. So purely mechanically applying the IRR rule for these two independent projects, you would go with both. However, what you can see is that the safety margin, if you were forced to pick one based on the IRR rule, you would see that A has a much higher profitability and also a higher safety margin. Okay, so that's all. So once Osama, just I'll take one question per, so whoever raises their hand first. Yeah, you can think of safety margin as 30. Okay, that was quick enough, so I can take yours. Yeah, so so even a profitability index gives you a sense for the safety margin. Okay, so what about MIRR? What's good about MIRR? It incorporates the reinvestment rate assumption. What does this statement mean? That the profitability index shows us the bang per buck or bang for the buck? Yeah, for $1 investment, it tells us how much we are getting back. So more bang, the better. Okay, now just in general, some points to remember. Okay, so the last few lectures have been very quantitative. Okay, this might lead us to believe that we just do the numbers and then we decide based on the numbers. But in reality, you do the numbers and those numbers constitute one input to your decision-making process. Okay, so that's a critical point. You don't just say, okay, I've done the numbers, NPV positive, do project. Okay, there are several other variables that you look at, and those other variables are not being discussed in this class. All that is being emphasized is that you've learned one important tool. The way I would look at it is, you would, for your commercial projects, so keeping aside, say, regulatory projects and so on, for a project to be done, the numbers must be good. Okay, and then if other things are also good, then you move forward. I don't think it ever makes sense to do a commercial project if the NPV is negative or if the rate of return is low. So this is a necessary prerequisite. And then there will be several other variables. Is there a strategic fit? Okay, so anyway, so there are several other areas that need to be looked at. Management, now let's say you are 5 years after IBA, so you are in a mid-management role, and a sharp IBA kid comes to you and shows you his calculations with very high IRR, very high NPV. Okay, what do you do? Yeah, you then make sure that is he making the correct assumptions? Is he doing the correct calculations? So you might have heard the phrase that if it is too good to be true, then it probably is. In other words, that there is probably something wrong. Okay, so the better the numbers, the more questions you should ask about where did these numbers come from. Exactly. One of the easiest things to do is just throw in good numbers in Excel and get out great return numbers. Okay, just you assume a high growth rate, and that can create hugely positive NPVs. Now, how do you deal with that? Okay, so you can debate all you want as to whether a growth rate assumption of 2% is right or 20% is right. End of the day, you need to make an estimate. Then what do? Every couple of months or every quarter, you should do an audit. What that means is, this is practical, real life stuff. So you've started a project, then keep evaluating whether the assumptions that you made are holding true as you do this project. Okay, now what if you had made certain assumptions about sales, okay, but it turns out that your sales are not as much as you expected? Then what do? This is think of it again as a general business student. So you had assumed a 15% growth rate in sales, but the actual growth rate is only 12%. So what will you do, Basit? Okay, अच्छा सही, okay. Okay, आपने अपने बॉस को कंफ्यूज कर दिया. Okay, one second. Okay, so somebody, so it's now way in your name? Yeah. Javeria. Okay, Javeria, loudly, what would you do? Do you understand the question? You had initially assumed a sales growth rate of 15% and all your cash flow projections were based on this. Now it turns out after, let's say, a couple of quarters, you notice that the actual growth rate is only 12%. What will you do? Reevaluate just the assumption. Okay. So you would change the assumption now to 12% and then do what? Okay, and then would you continue with the project or not? Now, my only suggestion and hint here is, while we all know this is a finance class, but the question I'm asking is in general. Say you are the CEO of the company. Okay, so a CEO of a company obviously needs to have one part of the brain that's thinking finance, but there need to be many other parts of the brain also. Okay, so that's your answer. Next, Mahin. Yeah, you are? Haneen, sorry. I got the last part right. Excellent. So this is a good response. Now, so when your assumption is not meeting, so you are at 12%. So I'm just giving you a larger picture here. So you are the CEO. So you figure out, are my salespeople doing a good job or not? Right? Maybe I don't have enough salespeople. Maybe I don't have good salespeople. Maybe my product needs to be tweaked so that I make my assumption. Now, if it turns out that the sales and marketing team is doing a good job, but it's just that the market acceptance for this project is not there and 12% is realistic, then I go back and reassess my net present value and my IRR with these new numbers. Okay, and if my project is still profitable, feasible, positive NPV, IRR greater than my cost of capital, I continue. Otherwise, I figure out a way of shutting down. So always, even if you are going for a finance interview at this stage, the most successful candidates are those who can show that they understand finance in the context of larger business problems. Okay, so if you just are purely pigeonholed as finance, then your success will be limited. So remember, finance is a tool. Okay, the ultimate goal is, at least from a business context, is to be successful at whatever business venture you're doing. So keep that in mind. Okay, so what are some of the main objectives of an audit? You want to improve your forecasts. Maybe, as I mentioned earlier, perhaps there is an issue with operations. I gave an operational issue in the context of sales. Maybe your sales team is not performing properly. Maybe another scenario might be that your costs are higher than you expected because the efficiency level is low. Okay, so see if you can improve that. Okay, and all else failing, say you are doing the best you can on sales, the best you can on your production, inventory management, raw material procurement, etc. So you're doing well on that, but still you are now looking at a negative NPV. Then you identify how and when to terminate the project. There again, I'm just giving you maybe more than the specific content of this course, but I think it's useful to you. Tying to your economics knowledge, what do you do? So you basically see, at least in the short run, are my variable costs, is the money that I'm generating exceeding my variable cost? In which case you keep going in the short run. Okay, if you can't even meet your variable costs, then your short run decision is to also stop. So ultimately, the most successful people amongst you will be able to bring together all these pieces of knowledge that you are learning across different classes. Okay, now we will talk about some special applications of the material that we've learned. One application is, how do you compare two projects that have unequal lives? There are multiple approaches for doing this. The approach that we learn in this class is the replacement chain approach. This one is we will not do here. Another thing we learn is the concept of economic life versus physical life. Okay, so let's say you have two projects. We are now talking about comparing two projects that do not have an equal life. You have project S, where you invest 100 and then you get 60 and 60. And you have another project where you invest 100 and then you get 33.5 over 4 years. Okay, let's say you are also told that this business is a very simple business where you are buying a photocopy machine and then you are selling photocopies. So your option A is to buy a relatively cheap machine which lasts only 2 years, but you make more money because maybe the maintenance cost is low, versus you buy another machine where the cost is the same but the maintenance cost is slightly higher, and this goes on for 4 years. Assume rather simplistically that when this machine goes bust after 2 years, you can buy another one at the same cost. So for simplicity, we are assuming no inflation. And that again you can use for 2 years and generate the same cash flow. Okay. Now, how do you figure out which machine to go with? Machine S or machine L? Okay. The first simplistic thing you might do is, if you can you stare at these cash flows and memorize them? Yes. Okay. So if you simply take the NPV of S and L, the way they were given, in project S you invested 100 and you got 60. What does this 2 mean? 60 over 2 years. And what do you think this 10 means? That's your interest rate. Okay. And you get a NPV of 4132. On the other project, same initial investment. What is this number? The cash flow. What's the 4? 4. And the 10 is the same discount rate. Okay. And here you get a higher NPV. So purely based on what you see here, which project will you select? But is there something wrong with this analysis? Yeah, there is something wrong, because you are not comparing apples to apples. Okay, there is one project where you are going for 2 years, and one where you are going for 4 years. Okay, so what do you think? Actually, let me. So now that if I tell you that you can do this project over, you can repeat project S, then how will you figure out whether L is still better or not? Okay, do it. In the interest of time, let me just show you what you should have done. Okay, so if you can repeat S, this is what your cash flow would look like. So you would have 100, 60, 60, and then you would make an investment again at the end of year 2, which would mean that you have a net cash flow of minus 40, and then 60 and 60 again. Can you find the NPV of this? You should get this NPV. Now, is this NPV more than the NPV of L? So if you can actually do this project, if you can actually create a replacement chain, so project S after 2 years is again done, then that project S is actually better than L. Yeah, if the project cannot be repeated, then L is better. But if I'm telling you, obviously with most exercises that you do, you have to make some assumptions. So I am giving you the assumption that maybe you can contractually lock in the fact that after 2 years you can buy that machine again for the same price. And let's say contractually with your customers, you also lock in that you will be selling them photocopies for 60 and 60. Okay, so obviously these are manufactured assumptions, but at this point in time, I'm just illustrating a concept that when you compare two projects, try to do a apples to apples comparison. So for example, if I have two other projects, X and Y, X is a 2-year project, Y is a 3-year project, and here again I tell you that in both these projects you can create a replacement chain. So as soon as this X machine goes bad after 2 years, you can buy a new X machine, and Y goes bad after 3 years, you can buy a new Y machine. What will you do in this problem? The first I asked. So what's the question? So Ayub, next. Exactly. So where did the 6 come from? Yeah, it's the LCM of 2 and 3. So effectively we are creating a apples to apples comparison. Okay, so all you are doing is putting both projects on the same timeline, and then you are solving. Okay. Now the next concept is the concept of, okay, please. So that is done. If you had issues, you can stay back after class. Now the next and different concept is economic life versus physical life. And just to understand the distinction, I'll give you a simple example. Physical life refers to how long an engineer says this machine will last. So it's an estimate. Okay. Whereas economic life is how long will the machine be kept in order to maximize the economic value. I'll give you an example of a very simple analysis a friend of mine did in America. He liked to drive new cars, so he wanted to do an analysis that what is the optimum amount of time I should keep my car. Okay, now for the sort of cars that he bought, let's say that the physical life was 15 years. Okay, that means that he could drive the car for 15 years and then it would be complete garbage and worthless after 15 years. So that's referred to driving a car into the ground. So use it as much as possible, which we are probably familiar with. Okay, another option is to recognize the fact that if I drive the car for 3 to 4 years, it will still have substantial resale value. Okay, and the other advantage would be that for the first 3 to 4 years, the maintenance cost is very low. Okay, so maybe economically I am better off driving a car for 3 to 4 years, even though I am spending money selling my old car and replacing it with a new one, but I'm saving a lot on maintenance cost because cars have relatively high maintenance cost after 3 to 4 years. So if I do an analysis and I figure out that overall economically I'm better off replacing my car after every 3 to 4 years, then the economic life is 3 to 4 years because I maximize my economic value by holding the car for 3 to 4 years. Whereas the physical life or the engineering life is 15 years. Now, as business school students, what are we more concerned with? We should be more concerned with the economic life. So, how do we do this analysis? Let's look at it through a very simple example. Okay, now let's say that we again look at a simple photocopy machine. You buy it for $5,000. If you sell it immediately at year 0, you sell it for the same price. Okay, if you use the machine for 1 year, then the cash flow that you generate in year 1 is 2,100. The salvage value at the end of year 1 is 3,100. If you use the machine for 2 years, then what's your cash flow? In the first year, you got that 2,100 by selling your photocopies. In year 2, you generated 2,000. What do you think this 2,000 means? Yeah, if you sell it at the end of 2 years, you make 2,000. Now, if you run this machine into the ground, which means you use it for its entire engineering life, you make some money. Where's this money coming from? Yeah, so this is your regular operations, your photocopying, you make this money. And then, but the machine just breaks down and is junk at the end of year 3, so your salvage value is 0. So what's the engineering life here, or the physical life? Is 3 years. What's the economic life? How do you know? Okay, so how do you, the way you do this analysis, let me see if you can do this. If you sell the machine after 1 year, what's your cash flow?
5,200.
So initial investment is 5,000. So this is your 1 year model. And at the end of 1 year, how much cash flow do you get, Farhad? How much, if you use the machine for 1 year, what's your cash flow for year 0 and year 1? So what's the cash flow 1? So what's the cash flow over here at the end of year 1? Just 2,100? I'm telling you that you're just using it for 1 year, which means that you are selling it after 1 year. 5,200. Assume a discount rate of 10%. So this is option 1. In option 2, you use the machine for 2 years. What's the next to Farhad is? Shoaib. What's your cash flow for year 0, year 1 and year 2? Minus 5,000. 2,100. Then 4,000. Does everybody understand? So next to Farhad is? Ali Raza. Do you agree with these numbers?
Yes.
Okay. Does anybody disagree with these numbers or not understand the numbers? Nabiya, where do these numbers come from? Yeah, exactly. So you invest the 5,000. This is your year 1 cash flow, and for year 2, you generate that cash flow, and end of year 2, you sell this. You add these two, and you get that 4,000. Okay. Now, how will you? And what if you use the machine for 3 years? Then 0, 1, 2, 3. What's your initial investment? 5,000. Year 1, 2,100, 2,000 and 1,750. Now, how will you compare these from an economic perspective? Yeah, so you figure out the NPV of each, and then how will you figure out what is the economic life? Exactly. Yeah, so you pick the one with the highest NPV. So for a smart IBA graduate, this is what you do to figure out how long to keep a machine, rather than simply say, okay, engineer said 3 years, so we keep it for 3 years. Okay, now just to show you the numbers, what does this slide show you? These are if you do not terminate, this is what an engineer might do, right? Okay, but you would do the whole analysis. Okay, what does this show you? Yeah, it shows that if you, what does the no mean? Yeah, so you just use the machine for its entire physical life. That's negative NPV. If you use it for 2 years and then sell it, so this is your economic life of 2 years. Obviously, this was a simplistic example, but it illustrates an important point. Okay, so the conclusion is, except only if you operate this project for 2 years, okay, a project's engineering life does not always equal its economic life. Okay, so the whole of this chapter is on your exam. So, as in, if you want to take off, you can. I'll not stop. Okay, so now this is the last segment of this chapter, and you can just close your book, sit back, keep your brains open, and relax. Choosing an optimal capital budget. Now, according to finance theory, what should be done is you just accept all positive NPV projects. But that would mean a unlimited budget. Okay, realistically, does that happen? Realistically, as in very few companies have unlimited budgets. So, two issues with having, doing all positive NPV projects. One is, as you keep trying to raise more money, what do you think happens to your cost of capital? The cost of capital keeps going up. Okay, so that's one issue. The other issue is, most companies do something called capital rationing, which means that they say, okay, we have this budget. For most companies, a budget is set for a given year. Okay, why do we have increasing cost of capital? Because as we try to raise more and more money, then if we are going to the bank and constantly borrowing more, what will happen to our cost of borrowing? Yeah, so our from a bank's perspective, if I am borrowing more and more, the riskiness is higher, so the cost of borrowing keeps increasing. Okay, so that's an issue. Okay, so the way, I think this is an important little depiction. So if I draw a graph, the x-axis represents the new money raised. So how much money am I raising? And this represents my WACC or my cost. Okay. So as I raise more and more money, will my cost go up? Okay. Now let's say in blue I represent the return on projects. So the return or the IRR as I am spending money on new projects. So this is my, so new projects. When you have, say, a certain amount of money, initially will you invest in the high return projects? So your first couple of $1 million go in the high return projects or low return projects? So you will start with the high return projects, and then as you do more and more projects, they will be the lower return projects. So if you look at the return line, that's going to be downward sloping. Now take a wild guess. What do you think the optimal capital budget is? Yeah, this is not technically called the cross, as in, this is where they intersect. Now what is the logic here? Let's say you are at some point X, okay, this amount of money. At X, does the return exceed the cost? If the return exceeds the cost, then does it make sense to keep investing? Okay. What about if you are at point Y? At point Y, the cost is more than the return, so it makes sense to scale back. So effectively, that shows your optimal capital budget. Okay, now the last segment, capital rationing. Capital rationing occurs when a company chooses not to fund all positive NPV projects. The company typically sets an upper limit on the total amount of capital expenditure that it will make in the upcoming year. Does this seem familiar? Okay, so this is where capital rationing is happening. Now, companies want to avoid direct costs, flotation costs, and indirect costs of issuing new capital. So a company says we don't want to do more projects because the cost of capital becomes too high. What is a way to overcome this issue? One is that you can, if you know that what will flotation cost do to your cost of capital? It will increase the cost of capital. So what you can do is only do projects that exceed that increased cost of capital. Okay, so build that into your model. So this is one thing you can do. What if somebody comes and tells you that we don't have enough management, marketing, engineering staff? So all of you bright people have not entered the workforce yet. Okay, so there is a limitation of the amount of talent out there. All right, so what do firms do in this unfortunate scenario? So they create models, what's called linear programming models. So they model the limitations that they currently have. Okay, so our current team is not that smart, not that bright. So given this limitation, we can only do these projects. Once you enter the workforce, then that limitation can be eased a little bit. Okay, so we are just doing this this is a whole year's worth, this is a whole course in of itself. Okay, the last couple of points. If a company believes that a project manager's forecasts are unreasonably high, so you notice that this so-and-so manager or group keeps making forecasts that are too high, and it always seems that the NPV is high, but in reality it turns out that the NPV is negative because the actual cash flow turns out to be lower than what he had forecasted. Okay, so what would you do in this scenario? Either you would kick them out, or the other option is, let's say you can't do that, then every time he gives you numbers, you use a much higher discount rate for his cash flows.